Hello, everybody. It's Sunday. Good to see everybody here. Let's get into the story today. This one is a little bit different. It's going to be called the Wealth Reset. And we'll unpack what that's about. But the questions every week, it always never ceases to amaze me, is they are always so different. The themes that are discussed, etc. So I'm really grateful to everybody on Patreon. But let's get into the story. Just a guy on the internet and definitely not financial advice. Thank you all for coming. All the questions come from Patreon. And let's get into the first one, which is kind of interesting from A1 the Don. SOS really struggling here. Thank you so much for all you do. 32 years old, making $275K a year and 15,000 stock in America. Partner makes about 20K due to ongoing battle with depression due to family member passing. But it gets deeper. And I think this case study, the reason we chose this question is because it hits everybody kind of differently. Now, 114K in a 401k, 111K on stock mutual fund portfolio with stockbroker under the mutual fund called Davenport, DAVPX, which actually has done pretty well. 10K in a HSA, that's a health savings account. I want to invest in a 2 to 3K leftover for spending. 14,200 in GameStop, 43,000 in alts and meme coins. Roast me. And here's the real kicker: 310,000 in student loan debts and 36K in credit card debt. Really struggling here. Thanks for all you do. So I'm gonna be a little bit hard and tell you what you need to do. Well, I don't give financial advice, but I'm going to share what I would do. Now, you're very fortunate to be making so much money, so congratulations on that. That's awesome. And I hope your partner can get over things and find something to really burn a lot of energy on, like a sport or something that'd be helpful. But let's get into the story. First of all, this is a 3-step process, real simple and not financial advice. But cut the burn, cut the burn, cut the burn, save, literally downsize. If you have an expensive apartment, get a crappy one. Squeeze into a studio. I don't care. But you make a lot of money. You're blessed with that. But what you need to do now is start saving it to get rid of something that we'll get to part 2. You got 295K of household income, including your partners, and you should be able to live on 100K a year max by cutting non-essentials. Cut the expensive car lease, the expensive apartment, the fine dining experience, eat at home, all that crap. Very easy to do. Very easy to live on 100K a year. In fact, you can live very well on 100K a year if you're creative. And then pull any cash, etc., a high spending portion if needed, and it prevents new debt surprises. Part 1, cut the burn. Second thing, slash the debt, cut the debt, nuke the credit card. You should easily be able to pay off 10 to 15,000 a month in this credit card debt. And I guarantee you're probably paying 20 to 30% interest on it. It's murder. You've got to get rid of that first. Sell the high risk crap, GameStop, alts, memes, get rid of that. These are gamblers' plays, not for investments. When you have millions, then you can play with these things if you like, but not at this stage of the game, not with that debt level. Get rid of it. Okay, cash out the 57K, pay tax on the gains, get rid of the credit card debt, and then start chipping away at the student loans, okay? And reinvest whatever's left over. Very important, very important. And third part, investing. I did check out this DAVPX mutual fund. It's done well over the last 2 years, so well done there. And I looked at their holdings: Meta, Nvidia, Amazon, I don't know what Brookfield is, Microsoft, MasterCard, Broadcom, Rockwell, automation. All of these things actually have benefited United Healthcare. It's kind of like a mixed bag of good and bad and ugly. Google's in there, but I don't like mutual funds. This one has, granted, it's done well. I don't know if it's going to continue to do well. So what you could do is a couple of creative things. You can, well, get rid of that. Maybe pair trade in your tax-free account, your 401k, if you are allowed to invest in specific assets. You can even get creative pair trading some mutual funds if you're creative, like go from high-risk mutual funds back to cash, etc. Max your 401k contribution, 23,000 a year, and boost your savings rate. You have to save at least 50% of your net income and get rid of your debt. Okay, so that's your harsh reality. I'll recap again. Cut the burn. Literally, it's not hard. You should you guys make a ton of money. Start saving, cut the expenses, get rid of the debt. Okay, get rid of the crap, and then start investing properly. That's it. Real easy. No need to struggle and stay healthy. Next question is from Jordan's Films. My brother has an interesting theory. One of the many reasons retail isn't FOMOing into altcoins like they have in previous cycles is because of how hot the AI narrative is. It's the shiny new thing that didn't exist in previous cycles with all the underperformance this cycle. In altcoins, price manipulation, why would new retail investors risk their money in alts when AI stocks are the hot new thing that is outperforming everything, much safer than alts too? Do you think this theory holds water and could possibly keep us from getting a crazy blow off top we've all been waiting for? Absolutely. Absolutely. And if you've been in the community for 4 years, you know what my plan has always been: get to 2025, take profits, allocate to AI. That's been the plan since 2022. And it's good to have these multi-year plans so you can have a structure for how you invest and not just randomly hope that there is a blow off all season. So, yes, crypto is no longer the shiny new toy. AI stole the spotlight. Huge funding shift as well from VCs and investors pumping money into AI. And AI works, so does select crypto. But AI had immediate practical use cases, changing everything. And of course, talent drain. You could argue as well, some blockchain developers have pivoted to AI for higher pay. We saw the $100 million sign on bonuses at places like Meta. This all gets the developers very interested in what's happening. And I actually covered a video last week. Is AI bubble bursting? Why it could be great for crypto. So this cuts both ways. So yes, AI pulled a lot of the money from crypto into AI, but now the signs that maybe AI is bursting and maybe it's time for crypto to take a move. And by the way, Bitcoin's up $2,300 today, which isn't bad. And that rotation could be happening back again. So everything swings. It's like the flowers with the pollen. The ones with the most pollen get the most bees. When that pollen is depleted, they move on to a new flower. Maybe that new flower is crypto again. But the macro has never been a better setup for crypto than it is right now. Rate cuts, money printing, all that goodness. And crypto is real. DeFi is real. I mean, there are 5 applications on Solana that make more money than Ethereum in total. So it's a crazy time to be alive. It's all very real. So yes, your brother's right. But now it could be the time to return. Next question. Let freedom ride. Hello there. Thank you for your tireless work and dedication. Your reference often has 60% of the S&P 500 will be zombies by 2030, and how winners take most. And in the AI and crypto race, new financial trend over the next 5 to 10 years. That being said, why wouldn't you distribute more of your Tesla holdings and generally more of your portfolio into those Mag7 companies, such as Google, Microsoft, Apple, etc.? I realize we are Tesla bulls, but if the Mag7 is sure to take most, why wouldn't we just diversify into the Mag7, not just heavy Tesla? So I look at a couple of things. One, relative valuation. We had 3 beautiful years, literally, well, 2 and change, 2.75 like when Tesla fell to $106 because of the Twitter acquisition, which changed the world. How could you not double down and buy? It was extraordinarily oversold, and it was at 160 and then again at 220, etc., etc. So we had a great time to stack. Also, my method of investing is very few assets, very high concentration, and do things right calls against them as well. So first of all, the Mag7, I believe, and I'm painting with a bit of a broad brush here, I do believe many of them are mature businesses. Apple, for example, their biggest innovation is a new color iPhone. People joke about that for a long time. The giants are huge, but they're aging. They're more like defense plays than offense. I like to play offense. I want to get maximum returns. And they're past probably the most explosive growth phase. And yes, they're all very profitable, but they're a little bit stodgy. Now, that being said, Google is very interesting to me. I think of the Mag 6, excluding Tesla, Google is probably the most impressive, but it's also gotten very expensive. It was at $180 a few weeks ago. Um, there is also other things that impact some of these companies: the AI stuff, the antitrust stuff, the competition stuff, maybe some margin pressure, but they all spin off a ton of cash. So yes, they're worth holding. And I'm looking to build positions in them if they get cheap, but they'd have to do equivalent of falling to like 106 or 220 that Tesla did. And also this crazy disruption, not just hitting the S&P 500, but also hitting potentially the Mag7 as well. So you have people like Elon Musk building macro hard. Maybe they can change how enterprise software is done. That is what's very, very interesting as well. And there's also rumors that there's an economic slowdown and it's impacting Amazon and Meta, etc. So we'll wait and see what happens. But I believe Tesla is the best risk reward because they are at the center of multiple 4 big S curves: EVs, energy storage, robots, autonomy, robotaxis, all that good stuff. Energy is just infinite demand. That stuff is growing so fast, it's not even funny. They are doing, I think, 150% year over year in deployments. All the grids needed, all the data centers needed as well. Tesla FSD now has over 6 billion miles, and Elon Musk and even Morgan Stanley said autonomy is solved, which is huge. They are ramping next year to tens of thousands of robots. That's the Optimus robot. Crazy financial strength, 42 billion in cash. They build their own silicon, just like NVIDIA. And Elon says the new AI5, AI6 will be better than the GB300s in terms of power and use a lot less electricity. So for me, and I've broken out the TAMs for Tesla versus other things, nothing comes close. They're in the right place at the right time. And I also know that Elon Musk is the best capital allocator on the planet. And if it couldn't get any better, Elon just tweeted this as well a few hours ago. It sure is a tall order. Phil was questioning how the hell can it get to 400 billion EBITDA? That would blow out the water, the combined EBITDA of the Mag7. And that's in his comp plan. So people say, oh, he's getting paid too much. No. He has to deliver extraordinary results to get paid. And the guy hasn't been paid in 8 years. Okay, people forget that. And when he does get paid, he's got to pay taxes on that. So yeah, the governments make a ton of money. So when you build value, you create jobs and you keep the country competitive and all this type of good stuff. But few people see that. Anyway, Elon did say anybody can buy Tesla stock right now and come along for the ride. He is in war mode and has been for a long time. And yes, there will be bumps along the way. But with a truly immense amount of work, these goals can be accomplished. Okay. I believe so too. So never before have we had a roadmap to a 10x like we have in this comp plan. And I guarantee you other companies will follow. But who can create nearly $500 billion in profits? $500 billion in EBITDA is wild. The milestones are incredibly difficult to achieve, but who else can do it? Anyway, that's why I do it. And, big bag of Tesla, covered calls, 10x, where the others may not exist in the future. That's my positioning. Next question from Francois. I would like to sell covered calls in my Tesla bags on mean reversion spikes using PTOS. Would 2 standard deviation be similar using the mean reversion in IADSS and the one in PTOS if I were to set USD or Dixie as the inverse? No. The core code for PTOS is very different to IADS, and do not use a dollar as the inverse asset. PTOS is designed for inverse correlated assets like 3x long, 3x short, or Tesla, Teslac, nothing else. Okay. The data model does not work unless it's the inverse. It identifies when things overbought and oversold and tells you to go long, to go short. It's that simple. Do not use anything else in there. Now, I do use IADSS mean reversion for covered calls. I'm going to walk through that as well because there's a ton of covered call covered call questions because I've been doing a lot of covered calls lately too. Left-hand screwdriver. Before we get to the covered call and option trading stuff, I will answer this very quickly because it's related to the previous question about Tesla. Is Hyundai a buy now? Now they've bought 50,000 GB300s and are moving with the times. This is interesting. First mover advantage is very important. Winners take most. Let's talk about Hyundai for a second. Yes, they're growing because other car companies are shrinking. And yes, Hyundai are doing well in their EV business, but they do not, I repeat, they do not have a story for FSD and autonomy. The other thing that's very alarming here, they have 160 mil M, whatever that is in Korean won. Their debt is through the roof. Okay. Very high debt, which is alarming to me. Now, let's talk about why Hyundai cannot catch FSD and a weird theory that I have too, why they bought the GB300s. 50,000 is a big lot of compute. First of all, Tesla has a massive real world compute advantage. Okay, they got over 6 billion miles. They got, millions of cars. They have all of the components on the vehicle to pull all the data. They analyze all the data. They can do it at scale. They have a neural network, etc., end-to-end vision platform. Hyundai has none of this. But the question is, why are they buying these boxes? I believe they're buying them because they might be licensing from Tesla and they need to be able to analyze their own data, spinning off their own vehicles. They probably buy the whole suite from Tesla, but it will still take a while to do it. But the Koreans can move faster than anybody else. And I think that's probably why they bought it. But would I buy Hyundai? No, not at all. No, stick with the winners. Don't play around the fringes. Next question from Nova Prime. What percentage of good rule of thumb for a trailing stop limit order to always have in place to protect from a black swan event, a full market crash, etc.? Do you put one in place and stock Bitcoin you want to keep? No, because I watch the markets all the time and I'd rather not get wicked out. I'm going to walk through a basic rule of thumb and then a couple of charts to give you a feel for what I'm talking about. First of all, stocks typically 10% trailing stop loss. If you need to do one, that's fine. Volatile stocks, maybe 12, maybe 13%, maybe as high as 15%. And crypto, 15%, because crypto is very volatile. But there's a twist. There's a twist to this as well. First of all, if you look at Tesla, Tesla swings 10% all the time. If you put in a 10% stop loss, you'll be wiped out all the time. You just sell, 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 and then you have to buy back higher, because when these things wick down, you'll see here, all the 80% of the time it identifies the bottoms, it wicks right back up. So you don't want to lose your bag. Sometimes you just know the overall trajectory is going up. Just be patient and don't get wicked out. Next, Bitcoin is actually less volatile than Tesla right now. Who would have thunk Bitcoin used to be a bucking bronco? I hope people, bucking bronco is a type of jumping horse, I think. I hope it didn't sound funny, but literally Tesla is more volatile. And the other key thing when you're thinking about trailing stop losses, I wouldn't tend to do that. What I would put in place instead is identify support levels. So, for example, this is Bitcoin. You can see here we went down to 98,000 4 times in the last week or so. Now, Bitcoin price is 104,600. So, what you need to do is identify a layer like a floor. So this is layer 5 on the ATR model. It goes down to 96,500. This is historically very, very good support. If we break through 96.5, we could go a lot further. That's where I would put the Bitcoin stop loss if I wanted to play one and I was fine with selling my bag and incurring taxes and all that stuff. Not financial advice, but that's where how you look at layers and support layers as well, instead of trailing stop losses, because you will get wicked out, especially if you're in volatile assets. Be careful. Next, from JC Freebie. Have you not considered moving back into HPC-miners for a 2 to 3 years play? Most recently, Aaron got a 10 billion AI cloud deal with Microsoft, and several things suggest that HPC is a significant bottleneck for AI. It feels that the previous risk profile of miners has changed substantially. Have you done valuations of the HPC miners taking into account this transition? And if so, what are the results? Yes, as of about a year ago, I started factoring in those miners that had HPC exposure, and they got a big credit for that. So yes, that is taken into account. But let me tell you more of a broader story about the whole HPC space and why I am a little bit nervous. And remember, first rule of investing is don't lose money. Okay? Do not buy miners at this stage of the market. It is murder. And always, since the very beginning, for 5 years now, I've been saying Bitcoin mining is a cutthroat business. Never forget that. So let's talk about, I'm not going to talk about Iris Energy in general. I'm going to talk about the space and what has me very concerned about the space. Okay. First of all, a lot of the players in the space have massive debt. For example, CoreWeave, they're losing money, minus 24% margin, and they owe 15 billion in capital. And they're losing what, 300 million a quarter or a year? I can't remember. OpenAI burn rate are losing 10 billion plus 15 billion a quarter. And they need just 400 billion to stay afloat, and they're trying to raise 1.4 trillion. Good luck with that. They asked for a government bailout last week. Not going to happen. David Sachs said, no, go away. You guys, if you die on the vine, that's fine. There's 5 other players that can step in. Also, the whole HPC compute space survives on razor thin margins. Okay, this is expensive hardware, very expensive energy, and these machines are already dead within a year. So if you buy a bunch of GB300s now, like 50,000 from Hyundai, they could be obsolete in a year's time. There could be a GB400 or something next. Okay, and Oracle struggle. The rumors out there that yes, while they have a $500 billion backlog in compute and hyperscaler needs, etc., their margins are like 1% or thereabouts. So it's a software company that's used to like 40%, 60% margins. All of a sudden, they're razor thin. And this is the whole commoditization risk of the space. AI is a commodity, absolute race to the bottom, low margin utility, just like Bitcoin mining. It's the same game, different application. There isn't infinite money. OpenAI, ChatGPT is running out of money. They're burning through cash. They need 400 billion to stay afloat. So if this isn't an alarm bell for you all that came to light a week ago, it should be. So no, I would not be buying here. Now, that being said, there's a lot of value in select AI plays, ones that have coherent compute, very controlled burn, and generate a lot of money, but they are few and far between. Now, a little graphic here. This is why I believe it is just like Bitcoin mining, where there's a lot of crazy stuff like dilution and stuff. Hyperscalers are stuck in a profit war. Everyone's slashing prices to win business while drowning in debt and zero or razor thin margins. Okay. CoreWeave and OpenAI, the 2 biggest players, are losing heavily, and Oracle's margins are there. Just like Bitcoin, don't touch these at this stage of the game. Maybe in a bear market, but not now. I think it's a race to the bottom. I did warn you all a lot of harsh truths here at the beginning, but it's important. That's why billions are made in the bear, not at this stage of the game. Radko, here we get into some trading secrets and tips as well. Radko, you've mentioned using the ATR model to sell calls at peaks. No, I didn't. I don't use the ATR model for that. I use the ATR model to find out where an asset is at, but not to time my call selling. What about ATR to buy calls short term and at lows? So much here in this one little beautiful sentence, Radko, very nicely formulated. I love it, but I want to set you straight. First of all, I use mean reversion for call selling and put selling. Now, second thing, most important, buying short-term calls are the kiss of death. You buy time, lots of time. You buy something that expires in 60, 90 days, unless you have a huge amount of asymmetry in the information or data, you'll probably get smashed, okay? So you sell the short-term stuff, you buy the long-term stuff. You do not buy the short-term stuff. Make sure that's clear. And there's a whole bunch of other questions related. I'm going to walk through all of these now. From Giggy HR, thanks for all you do. Can you talk a little bit about the concept of selling covered calls specifically against your leaps? I understand the concept of selling covered calls. However, if you own the underlying stock, aren't you effectively just selling a covered call against your spot, as your spot would be sold off in the event of the share price? Yes. But what you're doing when you sell a call against a leap is you're doing something a little different. Let me try and explain with an example. I'm going to turn my camera off here. If you have a deep in the money leap as insurance, for example, a lot of you have the 140 leaps on Tesla that are expiring in January 2026, by the way. So make sure you got some cash to convert them into stock and hold that stock and then sell calls against that stock. But when you do have the underlying leap, in the event something happens, like the stock explodes to the upside, you need protection. So, for example, you sell a $110 call against a leap, the stock shoots up to 150 overnight. You have to exercise the leap. That's your insurance. Buy it at 70 and then sell the stock at 110, and you make 40 profit per share, plus any other premiums you got earlier. But the problem is, when you sell calls, you're giving somebody the right to buy at a low price. Yes, it's very lucrative, but sometimes they can go against you. Therefore, I like to time call selling very, very carefully and not just feel compelled to do it every single week. And then related to this is how we sell calls from Soul Sister. My goals are to enhance income and for my existing positions and increase my Tesla holdings cost effectively when the stock dips. I currently hold 1,500 shares. Woohoo! That's a big bag. It's a very nice bag. Congratulations. Because 300 is the bogey. And you have many multiples of 300. 5x 300. Awesome. Average cost 215. Awesome as well. You bought the dips for years. And I'm looking to generate income while potentially buying more shares at a lower price. I'm very bullish in Tesla long term. So am I. I'm wanting to sell cash secured puts to acquire additional Tesla shares at a discount while earning premiums. Yes, you can do that. As you know, I do a lot of that too. How should I select a target price for a cash secured put that I'd be more comfortable in buying Tesla at? I was thinking about using ATR model, to identify the levels that you find attractive. So for me, low 400 is very attractive, anything around 411, maybe 413, maybe under 411 if we can get there. And apart from using other tools in the suite, what you would use. So let me walk you through exactly how. It's really unbelievably easy. Mean reversion, you sell the puts on mean reversion bottoms. See all those green dots? Sell puts, sell puts, sell puts, sell puts. Then, it's very important, when you do that, the price typically goes up 85% of the time. Again, not hard. Also, you sell calls the exact same way, but at the top. Sell calls, sell calls, sell calls, sell calls, little red dots. Wait for the trend to turn. Sell the call. Boom. And typically, these big mean reversion spikes beyond multiple standard deviations, they tend to be anomalies. And when there is such volatility, the price of the options is very expensive. So when you're selling a put, you're selling an expensive put, so you do well. And after a big price spike to the upside, you're selling a call. The volatility is high. The options are expensive. You make a lot of premium. That's it. That's it. And don't forget to use your back test. Here, if you use the mean reversion back test model, your win rate's 84.62%. It's that simple. So don't overthink it and enjoy the ride. That's all you have to do. And this this week we sponsored Captain Macau. He loves helping human friends when they're washing dishes or preparing meals. And I met somebody that met two birds that actually talked the other day. And they said, "Who's your daddy?" Which was very funny. Anyway, these birds are so intelligent. It's crazy. And tomorrow, DCA live. Thank you. I'm going to do some live questions right now. Turn on the camera. A big thank you as well. Before I jump into those live questions from Anjo, DBF430, Super Engel Blackson, Nick M. I'm Colt, Signal 103, Gamble Brew, Psych Experience, and Dr. Pepper, CJ, and Doug One. Appreciate you all. Let's go get the questions. A big thank you once again to the mods in the chat, TND, Tesla, Shawnee, K8. You all rock. So let's see, Doc Intern. Thank you for all your hard work. Best patron out there. Woohoo. Thank you, CJR. Doc Intern, how would you not financial advise somebody to deploy 10 to 20K in today's market? Also take a break and watch the Brazilian Grand Prix. I would love to. I hope it's raining. It's always fun in the rain, but I don't even have a TV. So I don't even have I had an iPad. I don't know where it is. So yeah, I don't have a good time. But I'm so behind. I've got the whole season to watch one day, hopefully next year when I get time. So no spoilers. Anyway, BG, I missed your voice today. Yes, I did promise 5 years, 7 days a week videos, and either stop at the top of the bull or at 5 years. And we hit 5 years yesterday. So I took a day off. family pressure me to do so. So I do what they say. They're the boss, not me. Nick M, I'm happy to take a day off with you, Ladsale. Thank you. And I, by the way, I'm still working, just not doing a live stream. Still posting like crazy on Patreon and stuff like that. So, and also yesterday I prepared today's video as well. I am Colt. Wife and I own a rental house and duplex, but live with parents to save money. That's controlling the burn. I am Colt. I like it. We own Tesla, Sol, Bitcoin. What's the best strategy to buy our own home? Well, technically you have multiple properties. You have 3 units, rental house and a duplex, 2 apartments. You're already killing it. I think real estate is kind of funny. I like to forecast what's happening in the future. And unfortunately, in the age of AI, there's 2 things happening, 2 forces coming together. And this is going to sound very dark and ominous, so I apologize in advance, but I'm not going to sugarcoat stuff because these times are too important. AI is going to ravage jobs. People will have less money. We have boomers retiring and downsizing their homes. There'll be a glut of real estate out there in many, many cities and other places, and nobody will have money to buy them. So I do believe some prices will come down, especially for things like fixer-uppers. Learn skills, get handy, be patient, let your money roll in the market. You own Tesla, Sol. I think it was Matt Haugen said Salon's going to 10x. So I hope he's right. Not financial advice, Matt. Anyway, you just make savings and keep your eye out for deals. Build a matrix of 10 things you want in a house, like no pool, good schooling system, safe neighborhood, maybe good transport, big garden. Make your list of things and start configuring filters in Zillow and get familiar with the market and watch. And the best time to buy a house, by the way, and this is a buyer's market right now. There's nearly double the amount of houses for sale than there are buyers. But between Thanksgiving, which is I think in a couple of weeks, and mid-January, end of January, that is the dead season for real estate. Nobody buys in the dead season. So if you've got cash, you got money, that's when you shop. I'm not saying do it this year, but things will get better next year, at this time, a year from now, and then 2 years from now as well. Invest, build a bag, sell covered calls, build a pile of cash, and use that to deploy into real estate when the time comes. I'm Colt. Hope that helps. And congratulations on the 3 properties. Psych experience. Thanks, James. What you do. Love you. Love you too, man. And French Streamer, Anjo, DBF, Anglebax, and Signal 103, Gamble Brew, Dr. Pepper, Dog One, KH, Sean D, and the whole crew here. Appreciate you all. That was the Sunday show. I'll see you tomorrow morning. Have a good night, everybody. Bye-bye.